Does take us to our talk of the tape, how to play these markets over the remainder of the year. We will ask our panel that very question. Joe Terranova, Chief Market Strategist with Virtus Investment Partners. Marcy McGregor with Maryland Bank of America Private Bank. Malcolm Ethridge with the Capital Area Planning Group. Joe and Malcolm are CNBC contributors. Welcome all. Joe T.
Yes, sir.
To you first. So people are looking for more volatility as the election gets closer, but this is HSBC today, which bumps its target to 5,900. They had it at 54, so that's old news. 59 is where they think we can go. They have more visibility on earnings growth and rates. They suggest. What do you think?
I think that target is probably a little bit light if we have a year-end chase for performance. I think the larger question is, how exactly do you want to be positioned into the end of the year? And I'm always thinking to myself, when I study my portfolio, where could something go wrong? The first place I look is sentiment and positioning. And what troubles me is the price action this week. And look, a lot of people are saying, all right, don't worry about the rise in yields. We'll be okay with the rise in yields. The market will be able to digest that. But the rise in yields takes away the foundation of the rotation trade that was in place after the third quarter. The trade where you moved away from quality, you went high beta, you went small caps, you ignored quality. And I think the market right now is positioned in that basket. The market is not really positioned. It moved away from quality, and most importantly, it moved away from mega caps. And I'll tell you what, Tesla's up 20% today. I've watched it. I've actually traded some options. I don't have anything on right now, full disclosure. But there has not been one pullback today in Tesla. And to me, that is an indication of where we are in positioning with mega caps. Now, next week, you have mega cap earnings. And what I'm concerned about and what I'm troubled by is that we might be setting up for the chase for performance looking a lot like 2023. And in that environment, myself included, you're going to see underperformance.
Okay, so you think we're going to revert back to a quality and mega cap led market. You're not saying that the rise in yields puts the run into year end in jeopardy. You're just saying the makeup of it may not be what you once thought.
Correct. Built upon the way the market is currently positioned and the messages that I'm seeing internally in the market. Yeah, I'm wondering if that's how we're going to close it out.
And next week, once you really get the mega caps, is going to confirm that?
Well, yeah, I believe it will. You've got Microsoft, you've got Alphabet. Just look at the performance over the last 5 days. Really, the worst performing Mag 7 name is Meta. It's down maybe 1%, while the overall indexes are down significantly more than that. And you have some Mag 7 which are actually higher.
NASDAQ is off for the week, but only 0.5%. It's the majors that are down more. There have been some idiosyncratic issues with Dow stocks, which are making that index look a little bit worse. Obviously, but your point about the small caps is well taken because it's down almost 3% is the Russell. That's where you would see most acutely, right? The rise in yields and the impact on stocks?
Absolutely. And I think that's where, again, the sentiment and positioning went a little bit, turned too much toward optimism, turned too much more the belief that we were going to have.
What do you mean optimism?
Well, there was optimism surrounding the fact that the Federal Reserve was going to deliver more aggressively on rate cuts, and
they don't have to. They don't have to. Isn't optimism about the economy and the consumer, and knowing that rate cuts are coming anyway? Isn't that more important than the optimism that was once there about a whole bevy of a slew of cuts? You don't need the cuts like that.
I think that equity size class, specifically small caps, absolutely need.
Well, I'm not saying small caps don't, but the overall market is proving.
Oh, no. You're 100% correct. Absolutely. The market doesn't need the rate cuts. You're 100% correct. But to get that real broadening out, look, we're sitting here October 24th. Scott, we're still waiting for the small caps
I don't disagree with you on
to come and participate.
That's being proven out.
Right. But it's important to think about how is the market positioned. And I really believe the market might be off sides here, coming off of Q3, where it looked like, okay, a more aggressive Federal Reserve. You got a 10-year at 375 in early September. Now that 10-year is going to maybe go down to 350. And guess what? It reverses and goes the other way back towards 4.25. That's not a good recipe for that.
We'll see. I mean, it's all, it's near term, it's tactical trading. We shall see. Let's broaden the conversation. Marcy, what do you think? What are your thoughts on what Joe had to say?
Well, I think the ingredients are in place for this melt-up to continue. I won't be surprised by volatility either before or after the election. This could be a kind of sell the news type of market event. I would see any pullback as a buying opportunity because the ingredients are in place for this uptrend to continue. You have a Fed that is cutting. I think it'll be a slow, steady march ahead. Earnings are broadening. Ultimately, I think the catalyst for small caps isn't the Fed cutting. I think it needs to be earnings picking up in 2025. But when I look at the S&P by second quarter of next year, I think all 11 sectors will be part of this earnings growth party. And I think once we get to the new year, we're going to get a new influx of liquidity. So I think the recipe is there for this bull market to continue outside of some choppiness in the next few weeks. Agreed, sentiment has starting to heat up a little bit, so I'm watching it closely, but fundamentals are in place here.
Malcolm, that seems to be the prevailing thought. It's certainly one that I hear quite often. To see, get the noise, get the election out of the way, get some other stuff out of the way, and just keep your eye on the ball. Good economy, Fed is going to be cutting, consumers hanging in, rates aren't going to back up, that much more. What do you think?
Yeah, I agree. I was in agreement with Joe where he started off with the idea that he didn't say it this way, but I will, that animal spirits are definitely back. But I think so for a different reason. I don't necessarily think that yields are really the thing that's driving it here. I think that the Mag 7 trade once again is prevailing. I know you've heard me say that month after month after month when different analysts have come on to say that the market is broadening and this is going to be the moment where the market broadens. I think Tesla being up 20% on a revenue miss. I know earnings per share growth looks great, but I mean, on a revenue miss for a company that had no business being valued the way it was in the first place as an automotive, forget it, trying to convince us it's a tech company, that alone convinces me that the Mag 7 trade specifically, forget big tech for a second, still has a lot more way to go, because until something substantially comes in to break investor psychology that thinks that the Mag 7 is the place to be, everyone is afraid of being caught out like we were in Q4 of 2023. And I think that lends itself back to names like Tesla. We've seen Apple, who's up for the last if you look at the 6-month chart on Apple, it's up about 40%. And iPhone sales for the 16 haven't been all that awesome. We haven't had a chance to put our hands on Apple Intelligence just yet. Revenue growth, iPhone sales were slowing in the last couple of quarters. And so nothing substantial has happened with that company to make us believe that it's more profitable or going to be more profitable near term. But the stock is a rocket ship. And I think those are the kinds of things that prove that toward the end of this year, we're more likely to see us charging toward that 6,000 level than going back in the other direction.
So you think that 6-month move we're looking at right on the screen next to you in Apple, let's put that back up. You don't think that that's justified, the 36, I think it was, % move that we were just looking at?
I'm not necessarily saying that it's not justified to think that Apple is a place you want to park that capital. I'm saying that all of the fundamentals, the reasons that we're told that we should want to be long-term shareholders of Apple, all the reasons our friend Dan Ives tells me that I need to be hanging on to Apple, none of those things have really come to fruition yet, but the stock has still been rewarded for that positive sentiment without any results.
Joe, how do you see that? I mean, what we're learning heading into these earnings reports next week is that all stock performance in the mega caps is not created equal.
Correct.
Whereas once it was, it feels like we have had some divergence between the various names. NVIDIA's been an absolute rocket ship again. Apple's had a nice run there, but some of the others haven't performed as well.
Certainly in the third quarter was evidence to exactly what you're speaking about. Microsoft, Alphabet, underperforming in the quarter, Alphabet with really not a very good quarter for them. So, yes, I think you don't need the totality of the Mag 7 to work like we used to need it. I think good is going to be good enough. I think the AI thesis is so incredibly important. Just look at today. the formation of a lot of technology names and how they're trading, I think you have tremendous comfort if you're looking at the semis to see that Lam Research is responding well off of its earnings report. Lam Research is up about 4%. Lam Research is one of those names that we've all owned. It's part of the semi-equipment AI story. You wanted to see them deliver, in particular in the wake of what we heard from ASML. I'm less troubled about seeing IBM down 6%. Okay, IBM has come back nicely on the year. It's up 32%. Again, ServiceNow performing well, part of that AI story. So you want to ensure that as we move through this earnings season, that the AI thesis, which has been such a remarkable catalyst for the market and for earnings themselves, you want to make sure that it's just good enough to keep this secular bull market steady and on its direct trend.
Marcy, I mean, you're pretty broadly bullish, if I could suggest that. Aside from your obvious, being overweight equities at large, it's utilities, it's healthcare, it's discretionary, it's financials, core themes, AI, infrastructure. We're looking at data centers, security. Maybe you're talking about cybersecurity. You tell me.
Yeah, those are our themes looking ahead. One thing I'll point out for everybody to think about is the parallels to what we're going through in the market right now to 1995, the last time the Fed pulled off the mythical soft landing. If you look, technology was the market leadership heading into that first Fed cut, but financials actually emerged as leadership coming out of it. I think financials is showing a lot of technical leadership right now. It's a sector I wouldn't ignore. But yeah, utilities, the first time we've seen a rise in electrical power demand since the early 2000s. Also, 2000 is the last time we saw utilities as a sector perform like this. But I think 25 is going to be all about those big picture themes, including artificial intelligence, but things like infrastructure, defense and cybersecurity, and also some of these big demographic trends. So I think while we're broadly positive on the market, 25 is a year we should also think about trends and themes.
All right, Malcolm, I've got a couple of names that you actually like that you wanted to talk about. Digital Realty, DLR. Do that first. Why?
Yeah, I think it kind of goes with the theme that Marcy was just talking about, where you have a number of AI-oriented themes that are going to impact everything outside of just the Mag 7 names or the hyperscalers that we constantly talk about. Aside from needing a place to store all of the data, DLR is also very committed to this idea of being sustainable in their growth. And so they're getting reach outs from companies, the mega cap tech companies that are looking to build their own specific parks now, not just one facility with shared space, which has kind of been DLR, their playbook in recent past. They want their own entire campus where they can store that data that's being built by all of these different large language models and all that compute power. And so I think that makes them perfectly positioned to be sort of the next leg in this AI wave, where once we needed the LLM builders like the ChatGPT, then we needed NVIDIA, for example, to create the chips capable of handling all that compute. We might find out in the next year or two that actually having a place to store all that data that gets created is more valuable even than the GPUs that we've been excited about for the last year or two.
What about Zscaler?
Yeah, so Zscaler, I see after that Salt Typhoon attack, I'm even more bullish on the cybersecurity sector, which I know hasn't necessarily been the best place to be investing those dollars so far this year. But I am looking at the fact that the federal budget at about $13 billion for cyber defense has to be beefed up. There's no option going forward, regardless of who takes the helm at the White House come November 5th. And so I think that that is a really good place to be positioned. And Zscaler is probably number 3 on the list behind Palo Alto and CrowdStrike for who's likely to benefit from all that federal spending that's going to happen in that space.
Joe, cyber, I mean, a lot of these stocks have come back. They went through, obviously CrowdStrike had its problems. It's up 5.5% in a month. It's up still 19% year to date is CrowdStrike, even with the issues.
Come back very strongly. Palo Alto, CrowdStrike, and guess what? Here comes Fortinet. Fortinet, which has a really strong balance sheet, had some missteps, had some struggles. The cybersecurity thesis is a secular thesis. It's a thesis that I think investors need to give consideration to the same way they give consideration to AI, the same way they're giving consideration to GLP-1 drugs. It's something that you could put in your portfolio and really have a buy and hold mentality on it. One thing I will add right now for me, the best technology name, I'm not sure if Malcolm is in this name or not, is APP, which is AppLovin. The stock is up about 300% over the last year. It's just a remarkable story, and it actually has a reasonable valuation.
All right, we'll leave it there. We got to run. Guys, thank you very much. Marcy, we'll talk to you soon. Malcolm, of course, you as well as Joe, too.